You have 6 indicators on your chart right now, maybe more. RSI, MACD, moving averages, Bollinger Bands, stochastic, and every single one of them is showing you what already happened. Not what's happening now, what already happened. 5 bars ago, 14 bars ago, 26 bars ago. You're making decisions based on signals that are mathematically late, and you're wondering why your entries always feel one candle too slow, why the signal said oversold and price kept falling. It's not your discipline, it's your tools. The indicators you trust most are structurally incapable of showing you the present. They process closed candles. The move is already over by the time the signal hits your screen. 70 to 80% of retail traders lose money, and the primary tool they all share? Lagging indicators with default settings that make them perfectly predictable. In this video, I'm going to show you exactly why your indicators are late, how that lag turns you into a target, and what the market is actually showing you that no indicator can calculate. Let's start with what your favorite indicator is actually doing behind the scenes. Every indicator on your chart runs on the same fuel: past price data. There's no hidden algorithm scanning the future. Every popular indicator takes candles that have already closed, runs a formula on them, and gives you a number. Your 50-period moving average needs 50 completed candles before it draws a single dot. That dot shows where price has been, not where it's going. RSI, the Relative Strength Index, developed in 1978, default setting 14 periods. It measures the speed and magnitude of price changes over the last 14 bars. When RSI hits 30 and your screen flashes oversold, that reading is confirming a drop that already happened. The selling already occurred. The signal is a receipt, not a forecast. MACD. It uses a 12-period and a 26-period exponential moving average, the crossover signal that every trading course teaches you to watch for. It fires after the trend has already changed direction, by definition. The math cannot produce a signal before the move, because the math requires the move to have already started. Think of it like driving using only the rearview mirror. You can see where the road has been, but you can't see what's in front of you. That's what every indicator on your chart is doing, showing you the road behind you and calling it a signal. And here's what makes this costly. Every time you see RSI oversold and buy, you're entering based on a calculation that needed the drop to exist first. If the drop continues, the signal doesn't update fast enough. It stays oversold while price keeps falling. You hold, you average down, because the indicator says it must bounce. It doesn't bounce, it keeps dropping, and by the time RSI crosses back above 30, the move you wanted is already over. This is not a flaw in your strategy. This is a structural limitation of the tool. The math cannot show you the present. It can only summarize the past, but the lag isn't even the worst part. Here's what makes it genuinely dangerous. Millions of retail traders use the same indicators with the same default settings. Same 14-period RSI, same 50 and 200-period moving averages, same Bollinger Bands with a 20-period simple moving average and 2 standard deviations. These are default settings. They ship with every platform, every course teaches them, and that means millions of traders are watching the same levels, getting the same signals, and placing entries and stops at the same price. This is not a conspiracy. This is math. When you put your stop loss just below the 50-period moving average because that's what the course taught you, you are joining a crowd, a very large, very visible crowd, and institutional algorithms can see that crowd. Order flow research has documented stop-loss clustering around common technical levels for decades. Round numbers, moving average lines, Bollinger Band edges. These are the levels where retail orders stack up. And when enough orders stack up at one level, that level becomes a liquidity target. Here's what happens. Price approaches the 50-day moving average. Your indicator tells you it's support. You buy. You put your stop just below. Thousands of other traders do the exact same thing. Now there's a pool of stop-loss orders sitting just under that moving average. Sell orders waiting to be triggered. Smart money doesn't see support. Smart money sees liquidity. They push price through that level, just enough to trigger the stops, and then the real move begins. Often in the direction you originally expected. Your stop gets hit. You're out. Price reverses, and you sit there staring at a chart that is now doing exactly what you predicted without you on it. The indicator didn't protect you. The indicator put you in the exact spot where you were most vulnerable, because the indicator made your behavior predictable. Same tool, same settings, same levels, same stops. You weren't unlucky. You were visible. and that's worse. But most traders don't question the indicator, they question themselves. They think they need better discipline, better timing, so they do what feels logical. They add more indicators, and that's the next trap. When one indicator fails, the instinct is to add another. If RSI wasn't enough, add MACD for confirmation. If MACD whipsaws, add Bollinger Bands. Stack 3, 4, 5 indicators and wait for them all to agree. This feels smart. Multiple sources should mean higher probability. But here's the problem. Every single one of those indicators is calculated from the same input. Closed price candles, same data, different formulas, different numbers, but all derived from the identical source. It's like asking 3 friends for their opinion on a restaurant, and all 3 read the same single review before answering. You're not getting 3 independent opinions, you're getting one opinion filtered through 3 different voices. The information is the same, the confidence is false. RSI says oversold, MACD shows a bullish crossover. Price is touching the lower Bollinger Band. 3 signals, 1 conclusion, buy. But all 3 signals use the same 14 to 26 bars of closed price data to reach that conclusion. You don't have triple confirmation. You have a single lagged reading dressed up in 3 different outfits. And the danger is that stacking increases your confidence in a decision built on the same structural weakness. You size up, you widen your stop because 3 indicators can't all be wrong. They can all be wrong because they're all looking in the same rearview mirror. The Brazilian Securities Commission studied over 19,000 futures day traders. 97% of those who traded for more than 300 days lost money. They had every indicator on every platform. The tools didn't save them. More indicators doesn't mean more information. It means more confidence in the same late signal. And overconfidence in a lagging signal is more expensive than no signal at all. So if every indicator is late and combining them doesn't fix it, what actually shows you the present? Volume, order flow, market structure, information that exists in real time, on the current candle, at the current price, not calculated from bars that already closed. Volume doesn't require a look-back period. When a massive volume spike appears at a key level, it's telling you something is happening now, not 14 bars ago. Now. Buyers and sellers are committing capital at this price in this moment. That's real-time information. Order flow, the actual bid and ask imbalance at the current price, shows you which side is absorbing and which side is being consumed. No formula, no lag, just the raw record of who is stepping in and who is stepping back. Market structure, higher highs, higher lows, break of structure is observable on the current bar. You don't need 50 candles to see it. You need the last swing high and the current price. If the current candle breaks above the last lower high, structure has shifted. That's real time. Relative volume tells you if the current move has conviction. Breakout on 3 times average volume? Real. Breakout on half the average? A trap waiting to snap shut. No indicator calculation needed. This is what professional traders use. Prop firms don't teach RSI crossovers. They teach order flow, tape reading, and volume analysis. The tools that process what is happening, not what happened. The difference is structural. An indicator says, this already moved enough that my formula produced a signal. Volume and order flow say, capital is entering the market at this level right now. One is a summary of the past. The other is a record of the present. So what does the informed trader actually do with this? First, strip the chart. Remove every indicator that requires a look-back period longer than the current bar. If it needs 14 candles to produce a signal, it's showing you the past. Get it off your screen. Second, watch volume at key levels. When price approaches support or resistance, the volume bar tells you what's happening right now. High volume and a small candle? Absorption. Someone is holding that level. Low volume on a pullback? No supply. The trend is intact. Third, read market structure. Higher highs and higher lows don't need a formula. Break of structure doesn't need a setting. These are observable in real time, on any chart, in any market. Fourth, confirm with relative volume. Is the current move backed by real participation, or is it a low volume drift that will reverse the moment liquidity shows up? That single question eliminates more bad trades than any indicator combination. You're not a bad trader. You were given tools that are structurally incapable of showing you the present, and nobody told you. Every trading course handed you the rearview mirror and said it was a windshield. Now you know the difference. Stop trading the signal. start trading the market. If this changed how you think about your chart, tell me in the comments. Which indicator have you been relying on most? I read everyone. See you in the next video. Stay sharp.